Did Sherron Watkins' memo warn of Enron's collapse? Imagine being inside a company where things seem too good to be true. That was the case with Enron, a giant energy company that looked unstoppable. But in August 2001, a whistleblower named Sherron Watkins sent a memo that would shake the corporate world. She was vice president of corporate development at Enron, and she saw troubling signs. Her memo warned that Enron's financial success was mostly an illusion. She pointed out that the company was hiding debt and inflating profits using off-balance sheet entities. These special partnerships, called the Raptor Partnerships, were used to hide billions of dollars in debt. Watkins warned that if these practices continued, Enron could be seen as nothing more than a big accounting trick. She told the CEO, Kenneth Lay, that the company might collapse in a wave of scandals if the issues were not fixed quickly. Her memo was one of the earliest internal warnings about the depth of Enron's financial problems. She provided detailed documents and analysis showing how the company's financial statements did not reflected its real economic condition. Watkins believed that some of the top executives might already be aware of these issues, but she wanted to make sure they knew the risks. Her warning was a big deal because it exposed the dangerous accounting tricks Enron was using to keep its stock price high. This memo is now seen as a key moment in the unraveling of one of the biggest corporate scandals in American history. It showed how complex financial engineering and lack of transparency can hide serious problems until it is too late. Watkins' actions helped trigger investigations that eventually led to Enron's bankruptcy in December 2001. Her courage to speak out, despite the risks, highlighted the importance of internal whistleblowing in preventing financial disasters. Her warning also played a role in the creation of laws like the Sarbanes-Oxley Act, which aimed to improve corporate accountability and prevent similar scandals. In practical terms, her memo is a clear example of how risky accounting practices, like using off-balance sheet entities, can mislead investors and regulators. It reminds us that vigilance from corporate officers, auditors, and regulators is essential to keep financial statements honest. Watkins' decision to raise her concerns showed strong ethical responsibility and helped bring attention to the dangers of aggressive accounting. Her story is a reminder that sometimes speaking out can prevent a disaster and protect millions of investors from losing their savings.